Well, hello everybody. I assume you all are hearing me. It's our first time using Cvent to produce and run our webinars, so I'm pretty excited. We got a nice fancy new tool. Can somebody just put in the chat, I want to verify that you are seeing me on camera and that you are hearing me nice, loud and clear, and we're all ready to go. I'm just going to wait for somebody to bring chat. Here we go. Lisa, hello. Oh man, I've recognized names. So look at everybody coming in. This is awesome. Okay, see you in here. Awesome. You know, get a little nervous first time we use a new package, but this is going to be us going forward. Is the Cvent route. We appreciate you all being here. I know many of you probably been on some of our webinars in the past, so thank you. You'll notice something a little bit different today, just the way that the presentation goes. So today, as you can see now on the screen, we will be talking about IRS updates on 3 different areas. It may go a 4th, but we'll see where we go. You know, I tend to go on tangents at times, but there's an interesting tangent that if we have time, I may go on today. But the main things we want to concentrate on are 174, which is the R&D expense capitalization rules that we're all thrilled that we've had to deal with now for nearly 2 years. That's not being sarcastic, obviously. R&D tax credit we're going to talk about because, man, there's some interesting things going on in R&D tax credits. And Phil Williams will be with me later to go over a new process that we have in place on R&D and talk about why we have to do this, what's happened in the last few years with the R&D credit from an IRS standpoint. And then everybody's favorite subject, ERC. Again, being sarcastic. But IRS had given us... what was it? Probably nearly 2 years ago now. They put out one of their notices and said, this is the last guidance we're going to give you on ERC. And now they've bombarded us with some stuff over the last few months. So we really need to give an update on there because there's obviously a lot going on. So I don't know if you're here for all 3 or which one, but this is most likely the order. I actually might go R&D tax credits first. So we shall see. CPE, this is available for CPE. To get your certificate, to get credit for this course, you need to be logged in for 50 minutes and you will need to answer 3 of the 4 polling questions that will pop up throughout the presentation. A little bit different than we've done on Zoom before, but the plan is we will announce those when they pop up so you see them. Just make sure you answer them. That's the proof that you're here. And if you meet those 2 requirements, we will send your certificate out to the email you addressed or that you registered with. Just be aware, check your spam, check your junk if you didn't receive it. And I honestly don't know when you should receive that, how quick it's going on, but I think it's fairly quick, sometime next week. And Mark can put in the chat if that's any different. That's the housekeeping. Now, who am I? Well, I'll get to be here talking to you for the next 50 minutes or so. Randy Crabtree, I'm a CPA, came out of public accounting, was managing partner of a firm that I actually merged in with another firm about 17 years ago when I started Trimerit with Andy Lane. Trimerit's a specialty tax professional firm dealing with credits and incentives. You can see the things. I do other things as well. Most of it's out talking at different events. All right, so Trimerit, I know a lot of you have been on our webinars before, but just as a quick reminder, here's what we do. We support you. We support the tax preparer. Honestly, I'd rather that said advisor, planner, not preparer, because we give you the tools to help in the advising and the planning that you go do at the end of the year or all year long with your clients. And so we really look at ourselves as an extension of your advisory team to help lessen the tax burden on your clients and increase their cash flow. And this is going to be important. We spend more time qualifying, quantifying, and documenting credits because that allows us to spend less time defending. This is something Phil will go into as he talks about the new R&D tax credit documentation process that we've put in place, and he'll explain why that was important. And then you can see what we do here, all these different credits and incentives. A hot topic that we'll probably do a webinar on maybe even next month is the renewable energy tax credits, which is something that you'll be running into a lot over the next few years and probably even this tax season. So just be aware of that. Agenda, Those things I just talked about. But what specifically? R&D tax credit, there's a brand new proposed Form 6765, and that gives us some obviously really good indicators of what IRS is looking for in the process of submitting an R&D tax credit claim, and that rolls directly into that documentation process. So that'll be the first thing we do to go over, and I'll introduce Phil in a few minutes on that. 174. We're going to go in the background of what it is, why it is, what the Tax Cut and Jobs Act did to us. We all know that. More importantly, we're going to talk about what IRS guidance just came out, because they came out with a notice that finally, basically a week before September 15th, finally gave us some guidance on how they define a 174 expense. So we're going to go over that, and then the ERC stuff that I mentioned before. Now, talking about three things in an hour. We're not going to go deep in any of these. We're going to give you an overview on these. If we want to go deeper, you can reach out to us anytime or look at another webinar that we'll be doing in the coming months. So I'm getting used to how you forward these slides, and it looks like it's all based on my mouse right now. All right, R&D tax credit first. Before I introduce Phil, let me give you just a quick definition on R&D, because more importantly, I want to talk about the expenses. But to qualify for an R&D tax credit, you got to meet a 4-part test, and that's pretty straightforward. You've probably heard this before, but you look at your client's projects and see if they meet this 4-part test, which is, do they meet the permitted purpose? And that means, is there a new or improved product, process, technique, formula, invention, or software? Software is going to be interesting because we're going to talk about software in the 174 guidance that we recently got. And there's kind of a new definition of software as well. So new or improved product, process, technique, invention, formula, or software. Is there technology based in what we're doing? So hard science, computer science, chemistry, biology, some kind of hard science involved with what we're doing, not marketing or management techniques or anything like that. And I do get that question a lot, and that's not part of the R&D tax credit, coming up with new processes to have materials run through your office. No technical nature to that. And then technical uncertainty is a key. And the technical uncertainty is, can we do this? Is it possible? Can we be more efficient? Can we do this better, faster, cheaper? How do we determine how we reduce operations in this manufacturing process? So some kind of technical uncertainty. And then because we have the uncertainty, we're going to experiment. Experimentation and uncertainty, really the key to what we're doing with the R&D tax credit. And this is going to be more key at the project level, as Phil's going to talk about later. So experimentation is, we're evaluating different alternatives to see if we can answer whatever that question is we have. Can we reduce operations? Can we make this product in general? Can we make the software do what we want it to do? So that's how you qualify. More importantly, I want to talk about expenses here, because all these expenses for the R&D tax credit, which is Code Section 41, are also 174 expenses, which is what we have to capitalize now based on what happened in the Tax Cut and Jobs Act. So the expenses in Code Section 41, the credit, that have to qualify as an expense under 174 are very minuscule compared to all the 174 expenses that qualify for capitalization. Salaries and wages, who in our companies, doing designing, evaluating all alternatives, prototyping, testing, salaries and wages during the R&D process. Are we outsourcing some of those costs, outside services to, test, prototype, whatever? Supply cost, which could be interesting. Supply costs are materials consumed in the R&D process, which that definition changed a few years back and brought more supplies into a potential R&D tax credit arena, which are great for the credit. Would we rather that they weren't 174 expenses now with the capitalization? Yeah, possibly, because supply cost potentially got converted from a cost of goods sold or an expense that, I guess a fixed asset may be in a similar line, but potentially some of them could have been cost of goods sold in the past that now potentially become 174, which normally we're not going to amortize cost of goods sold over 5 years. With these new capitalization rules, we're going to have to. So supply cost, qualifies for the R&D credit. And then rental of computer time's the last one. We're not going to really talk about this much when we're talking about capitalization, but this credit being defined in 1981, more rental of computer time. I actually took the very first computer class in my high school back in 1979, and we didn't have many computers then, and there was only about 3 of us in the class, so people were renting computer time. That has become more prevalent again, and some of those like AWS and cloud computing services, there's a potential there that we can see some potential costs going into the R&D tax credit from them. All right, so now let's get into what's changing with the R&D tax credit. And there's a little bit of history here. Back in 2001, this was actually a surprise. The IRS released a, basically information release or news release back October of 21 that defined a new method for documenting R&D tax credits. Now, this new method was only to be used on amended tax return. But from day one when this came out, and I think most of us, I know I've been talking about since then, that this would eventually be for all tax return. And that's kind of what we're seeing going forward. So just to summarize this before we go into the new Form 6765, this memorandum that came out at the end of 21, so 2 years ago now, told us that we're going to have to start on amended tax returns. At this point in time, this was only amended tax returns, that we would start to have to identify at the business component level, the newer improved product, process, technique, formula, invention, or software. At that level, what were the research activities, who the individuals were that were working on these research activities, and what information each individual was looking to discover. And then it went further to say, and then we need to provide all the QREs. We're going to have a new definition somewhat of qualified expenses, but all the qualified QREs at each level, the employee level, the supply cost level, the contract research level. And that's what this memorandum that came out 2 years ago said. Now, currently in September of 23, so what are we, November now, 2 months ago, IRS released an information return said that, hey, we just released a draft documentation of a new Form 6765. Well, surprise, surprise. That kind of coincides with what they put out on amended returns 2 years ago. In this release, they said, hey, this is our proposal. Although when they're talking about it, they say, we expect this to be it. But this is our proposal. But we want your feedback. That's a typo there. Their feedback was due October 31st of this last month. So that's already gone. I just want everybody to know the first poll question is just being launched. So make sure that you answer that first poll question, because you want to make sure. Again, I'm going to announce them now. In the future, we may not, but first time using Cvent, I just want you to make sure that you are seeing those polling questions. All right, so they were asking for feedback. We submitted feedback on what we thought of what they were asking for. And in this new Form 6765, there was 2 new sections, and this is really the key. There was a little bit of other changes too, but so this is the new information. Now we're to that was background. Now we're to the new information that we're seeing, and what the IRS is requiring from us. These 2 new sections, Section E of Form 6765, and I was going to put a copy of it up here, but it would have been too small. You wouldn't have seen much. They're asking these new questions. Tell us the number of business components that is generating this credit. Tell us the amount of officer wages included in your QREs, your qualified research expenses. And they're asking that because there's been some court cases in the past where officers' wages, you have an owner who, and this is my opinion, you have an owner that was making $5 million a year, and they were getting this money not simply from doing R&D, but they spend the majority of their time doing technical uncertainty work. And so that officer wages was included in the credit. I think here they want to make sure that this officer wages is not out of line, and whatever we use in the credit is an amount that would be paid to somebody who wasn't the owner of the business. So I'm guessing that that's why that question is there. They also ask if there is, that we identify if we acquired or dispose of a major portion of our trade or business. The R&D tax credit's based on consistency rules. We have to compare similar things we're doing today to what we were doing in the past. So just making sure that if they see a calculation method change, and is that based on acquiring or disposing of a trade portion of our trade or business, and identify any new categories of expenditures that are included in the current year that may not have been included in the base year. So do we have new expenditures that is going to not be reflective of things we did in the past? And so those are the new questions, along with determining if any of our QREs were following an audit directive, ASC 730. A few years back, IRS came out and said, hey, if you are calculating your R&D tax credit based on using numbers that were in an audited financial statement following ASC 730, then we are basically making your credit audit proof, for lack of a better term. And I think they're probably asking that, and Phil may have a different opinion on this, but I think they're probably asking that to basically help them know if they need to look at this return any further. And then the next section that they put into this new Form 6765, which is not official yet, but the time to submit. Now, I think they said they'd still look at your information if you submit it after October 31st, but they can't guarantee it'll be incorporated into the form. And so if you want to put any information on this, you still can, but doesn't necessarily mean it's going to affect their decision making. All right, the other new section is Section F in Form 6765. In there, they want us to identify controlled group members by ID number and principal business activity code. Again, the R&D tax credit is not, each entity stands alone. If we have a controlled group, we have to look at the credit in whole. So I'm guessing they're looking to see if somebody's not following the control group levels. They can see that here. But then this is where they go, where it's kind of following what we saw 2 years ago. For each business component, put a description of the information that is being sought to be discovered and the alternatives that were evaluated during the experimentation. Talk about whether this is a new component or if we're improving something. What is the type of business component? And is this business component for sale, lease, license, or used internally? Because you can have R&D tax credits on products you use internally. And then they specifically ask about software, which we'll talk about more in 174, but they're identifying 10 different types of software that you can choose from that your R&D tax credit is based on. And then going back to the memorandum from 2023, they want us to break down QREs for each business component by direct research wages, direct supervision wages, direct support wages, and then that supply cost and the contract research. So they're going back to what they are not back. They're doing what we kind of assumed they would do when they define this amended documentation rule back in 21. They're now what we thought would bring that forward to currently filed returns as well. And so again, the feedback was already requested, but just so you know, some of the things they're asking for, and this makes a lot of sense to me, is, should we not require all that additional information for a certain dollar amount at the control group level, or a research credit less than a certain dollar amount at the control group level, or a companies that using the credit to offset payroll taxes? And there's a small business credit, basically, if you're a startup business, no revenue more than the last 5 years, and your current year credits less than 500,000 now, or no, the current year revenue is less than 5 million. Man, I'm losing my mind. You can use the credit and offset payroll taxes. So they're saying, should we not make these startup small businesses that are trying to get off the ground not have to do all this additional information? Obviously, I think that makes sense, but the feedback was do already. With that being said, this flows directly into our new documentation process, what we feel the IRS is going to be asking for. And I want to have Phil Williams jump in now, because Phil can give us a much better definition of why this new process is in place, what caused this to happen, and what we're doing to meet the more stringent, at least audit requirements that the IRS is putting out there. Phil, welcome to the webinar, and thank you for being here.
Thanks for having me, Randy. And you just put out there that I was going to answer a question that I can't answer. Because I can't tell you with any degree of certainty why.
Okay.
why this? I can certainly make a guess. I think most of our audience could probably make a guess as to why a lot of this is coming down the pike. But at the same time, I don't know for sure. But we can certainly talk through the rest of it. Many of the folks that are on this presentation or on this webinar today probably got an email from me on Tuesday. And that email was introducing some of the new processes that we're putting in place. And I guess just to give a little bit of background on that, and we're taking a lot of time to cover this, so I want to be sensitive that we don't go too deep on this, Randy. But throughout time, there's been, or not throughout time, it's a bit of an exaggeration, but over the course of the past 15 to 20 years, there were pieces of case law that came out. And as all of you know, when you're talking about taking a tax position, you start out with the code, you then have Treasury regulations that further define the code, and then you have case law that interprets it. And the case law that came down for most of the 2010s was super taxpayer positive. And you could rely upon that. And that was really where there was a great article that was released in Tax Notes this week that was passed along to me by Rich Bernstein, talking about the top-down versus the bottom-up approach to calculating an R&D credit. And that prior case law pretty much gave a green light on, yeah, we can go with that bottom-up approach. We can say, hey, here's a qualified project list, and then here's a group of employees, and as long as we can mesh the two of those, then it's defensible. And that's what we used at audit. That's what we used at appeals for years with really, really good results. And then you saw the cracks in the wall starting to form. And you had a couple of pieces of case law that were held down or handed down. You had the original Little Sandy Coal case that came down in 2021. You had a couple of very taxpayer negative contracts cases that came down in late 2020 and 2021. And then in 2023, you had Moore v. Commissioner, you had Betts v. Commissioner, and you had the Seventh Circuit appeal of Little Sandy Coal, where as we read those and as we processed what was being said, and then at the same time, as we started to see how exam and how appeals were utilizing those, it was that moment in time where we said, hey, we can't make small tweaks on this. We need to do a whole rebuild of how we're putting these credits together, or else we're potentially putting our clients at risk. So that was the driving force behind creating that top-down approach, starting with the projects and then creating a direct nexus between the projects, the wage expenses, the supply expenses, and the contract research expenses, and being able to display the vast majority of that information that's going to be likely required on the 2024 Form 6765. We're already going to have that as a byproduct of the enhanced study process that we're putting out there. Now, that enhanced study process, it's going to take more time. It's going to require more information from the taxpayer. So we're trying to get out in front of that. We had the CPA email that went out this past Tuesday. We have a client email, which is scheduled to go out on Monday, introducing that. So again, we can start those discussions about how that process is going to be improved. But long story short, it is aimed at fully falling in line with IRS expectations that were handed down in these pieces of case law, falling in line with the updated, or at least the interim Section 174 guidance, which will likely be final sometime either late this year or early next year. And get everybody back into compliance, which is where they need to be. There's nothing worse than losing an audit where you told somebody, hey, this is how it's going to go. And then you have a couple pieces of case law that are handed down between then and when the audit happens, and you get tripped up by that. And it's not right or wrong. It's just how that chain of events goes. So that's what we're going to be approaching. We're going to be getting a lot more detail from our clients. We're going to be digging deeper into the projects themselves, and we're going to get them to the spot where they can answer all of those questions, falling in line with both the Chief Counsel memorandum back in 2021, as well as what we're guessing is going to go on to that Form 6765.
Perfect. Can I ask you a question?
Maybe.
I can. Thank you very much. So we're getting some questions in already. People are already jumping to the 174 section, apparently, even though we haven't gone over that yet. And So, and and I know the IRS identified some of this, but I didn't study up on it for this specific. And so, if we don't have an answer, we'll get back to the person. But there is guidance in the memorandum that came out, of the notice that came out on 174 capitalization cost, on what happens to the cost when you sell your business. And I don't know if you had insight on that. It is in there. We will do a specific 174 where we'll go deeper into this stuff. But before I tell this person we'll get back to him on, I just wanted to see if you had any insight on that.
Which question specifically was that, Randy?
So what happens to R&D capitalized cost when you sell your business?
Okay, so there was mention in that interim guidance that came out on September 8th. And I'm going to probably cite the wrong section. But it said that if the sale of the business does not fall into a certain category. So basically, if you're selling a business, it's not considered to be it's considered to be an asset sale, not a stock sale.
Yep.
And forgive me if I'm flip-flopping those, but and then again, it is in the interim guidance. Then you can catch up with all of the remaining amortization at the sale of the business, which was really, really good to see, because before that was undefined. And right. we went probably a year and a half with questions being asked, like, hey, what do we do with this? And there was no guidance whatsoever on it. But that is covered, and it sounded like in most scenarios where it would be relevant, you could catch up on that amortization.
That's what I thought as well. And so we just had somebody ask another question, and I'm probably going to steal time from the rest of my presentation, but let's address this. The question is, will an R&D study, and again, we're jumping forward to 174 already, but that's our next section. Will an R&D study be necessary to figure out which expenses to capitalize? So let me start on this, Phil, and then you can add to it. Bottom line, I want everybody to realize, because I've been hearing this way too much, that my client doesn't want to do an R&D tax credit this year because they don't want to identify they have 174 expenses. You cannot file a tax return that way. Sorry if I'm preaching. But you cannot. If you know they have 174, the R&D tax credit has nothing to do with it. They're mutually exclusive. And so do you need to have, and I not get this specific question, I'm not saying it to this, but do you need to have an R&D tax credit study to figure out what's expenses? No, you don't have to have an R&D tax credit study. Should you do an R&D tax credit if you have 174 expenses? Well, it depends if you have the 174 expenses that also qualify for 41, the credit. Now, that being said, yes, I think to identify 174 expenses, you're going to need help, because believe us, we're digging deep into this and we're still figuring out some of the things. You, as the chief advisor to that client, aren't going to be able to dig deep as somebody else out there. And so whether it's us or somebody else, in my opinion, having a study done to identify 174 expenses is going to be important. And again, they're not mutually exclusive. I mean, they are mutually exclusive. The credit is separate from capitalization. Does the expenses in 174 affect the credit? Sure. But it's not, hey, I won't capitalize, therefore I won't do I won't do a credit, therefore I don't have to capitalize. No, not the case. All right, that's my rant. Anything to add on that, Phil?
No, I was just going to say, as something else that was included in that email, was that we have developed a Section 174 study program, like an actual deliverable, something that we can actually go out and assist clients with. We were hesitant to do that, not having guidance. We were hesitant to say, hey, we're going to help you out and do this. But at the same time, we were kind of filling in the blanks on some of the questions ourselves. And we couldn't stamp that guaranteed, because we were absent so much guidance. So now that we have the interim guidance, now that we're expecting the final guidance to come out sometime soon, we're comfortable advising around that. And where I'm getting at is a portion of that Section 174 study is determining what the direct experimental expenditures are, which is something that is a byproduct of the R&D study to begin with. So we've come up with a way to do that. There's additional information that needs to go into the 174 side of things, which is pulled off the trial balance or pulled off other areas of the return. But the direct wage expense and the other items that typically go into a Section 41 study can feed back into Section 174 without assistance.
Got it. And I just want everybody to know, poll question 2 is now up, so make sure you answer poll question number 2. Phil, you don't have to answer.
I'm still here.
All right, I'm going to move on then. But if you're able to stick around, great. If not, don't. But I got a feeling I'm going to start getting a lot more 174 expense questions too. So if you're able to stick around, that'd be awesome.
Yeah, I'll stick around. I can go off camera and start answering some of these questions to you.
Okay, why don't you do that? That'd be awesome. All right, Mark, if you could put the presentation back up, that would be awesome. Look, he's already ahead of the game here. All right, so Phil mentioned this already, the revamping and why, and it's because recent court decisions, and that's fine. They just want it. They just want the credit more documented at the component level, and that's fine. The only problem with that is it's going to make it harder for smaller clients to take advantage of an R&D tax credit because the cost of doing an R&D tax credit study is going to go up. That's one reason on Form 67, 65, they're trying to see if we should do like a de minimis rule. All right, so now to the section where questions are coming in. And I'm going to tell you this again in the next 30 minutes. We're not going to get deep into this. We're going to give you an overview, and the overview is going to be more on what a 174 expense is. There's other sections that they talked about of what happens when you sell your business, and what about control group, and what about a shared cost, and that will go deeper on in another presentation. But for right now, it's just so you can start to get an idea about what a 174 is. And just in general, this is the definition we've gone with 174. It's all cost incident to the development or improvement of a product. And I'm reading this: product, process, technique, pilot, model, formula, invention, similar property. That's kind of what we had in the past for definition. This that recently came out gave us a deeper definition. We've always been able to expense this. Obviously, this changed in the Tax Cut and Jobs Act. For the last almost 70 years, we've been able to deduct R&D expenses as incurred. Didn't really matter what the definition is, because for most of our clients, most of your clients, they just deducted them. You know the history. I won't go deep into this. Bottom line, Tax Cut and Jobs Act changed that, but kicked it down the road 5 years. Everybody assumed that it was never kick into place, and it did January 1st of 2022. So we're almost into 2 years of us having to capitalize R&D expenses, 174. And again, not to rant and preach or anything, but you can't ignore a 174 expense. A 174 expense exists whether you take a credit or not. And so just be aware of that. You as a preparer need to inform your clients that this is not something you're forcing them to do. This is tax code. And if they want to follow tax law, they have to capitalize 174 expenses. And now we have a deeper definition. So you can't play ignorant. Not you could anyways, but you're not going to be able to play ignorant with what a 174 is and what a 174 isn't. And so the new rules are we have to capitalize and amortize over 60 months, and we have to cap for U.S.-based domestic expenditures, and capitalize and amortize over 180 months for international expenditures. And now we finally got this guidance that they promised us, came out recently under IRS Notice 2023-63. We will dig into that here in a minute. Obviously, we never thought we'd have to deal with it, and that's why we're late to the, not us late, that's why everybody's late to the table and trying to figure out what a 174 is, because we never thought we'd have to do that. Honestly, capitalizing the credit, look at me. Now I'm not keeping them separate. Capitalizing 174 expenses is going to cost your client money in the first year, the second year, the third year, the fourth year, even the fifth year. But after 5 years, we're really back to normal, because now we have 5 years of amortization. If we're not a growing business, if we're growing and spending more, then the amortization will never kick up. But this is almost just a timing difference. We're going to pay tax today that we would have paid in the future anyways. The bottom line is, though, nobody wants to pay this today. I mean, this is big hits. We're having small businesses, pay an additional $1 million in tax in some cases. This is a smaller one that's paying an extra 189. But this is what's happening. You all saw it last year. You all had clients that were not thrilled with their higher tax bills, and now we're about to be 2 years into this. It's going to be an interesting year again. Okay, before I get into the 174 definition, this question comes up to me all the time. So let's address this, because people were very confused. Is my R&D tax credit based on my amortization expense, or is my R&D tax credit based on the expenses incurred? Just be aware it's the expenses incurred. IRS made or Congress made a conforming amendment in the Tax Cut and Jobs Act that said we don't have to just rely on the amortization amount this year to qualify the credit. We can use the amount expensed during the year. And then one last thing that is pretty interesting. You may have heard me said this before, and IRS actually addressed this somewhat this year. The Tax Cut and Jobs Act made a conforming amendment on 280C, and basically, for the most part, I'm going to summarize this really quick. For the most part, what it said, at least the way I read it, and most other people read it too, and Congress or IRS has agreed with us from the standpoint that they think it was written wrong, is we almost don't have to do a reduced credit anymore, because we only have to adjust our expenses if our credit exceeds our current year expenses, not incurred, but expenses, and that's seldom going to happen. And the way this was written in the Tax Cut and Jobs Act is saying, in my opinion, this is not tax advice. You got to look at this. IRS says they're going to talk to Congress about this, but it is saying you don't really have to reduce the credit by the amount of the expenses. Now, I'm not telling you to do that. I'm telling you that that's how I read it. I'm telling you that that's most of the way people who are filing tax returns have done this year that we've talked to. All right. That's a lot of all rights, isn't it? Then let's get to the definition now of what IRS guidance we just received 2 months ago, a week before tax filing deadline, that what they've said is, okay, hey, here's the definition of 174 expenses. And they're saying 174 expenses are anything that satisfies code section 174-2, blah, 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 or they put in there, or are paid and occurred in connection with development of any computer software, regardless of whether these expenditures are research or experimental expenditures on 174-2. So they define it as all this R&D expense we know about, plus this additional software expense. And so they spend a lot of time defining software expenses, and we'll go over that. They also define SREs. Instead of QREs, they're starting to call it specified research expenditures, because I think the whole mindset is these are specific to this job. And so SREs are expenses incurred in connection with the taxpayer's trade or business, which you see what it says, represent a research and development experimentation cost in the laboratory sense. So what did they define are SREs then? Specified research expenditures. Specified? I think I'm saying that right. Labor cost. Full-time, part-time, contract, independent contractors who perform or supervise or directly support, not indirectly, but directly support the specified research activities, SRE activities. And this is where they went further then. Now let's figure out what includes. For Code Section 41, labor costs are box 1 of your W-2. If it's a contractor, independent contractor, it's 65% for the most part, 65% of what we pay them. For 174, they go up and above that. For 174, it says labor cost includes all elements of compensation other than severance, basic, stock options, overtime pay, vacation pay, holiday pay, sick pay, payroll taxes, a portion of taxes, pension costs, employee benefits, and payments to supplemental unemployment benefit plan. They fully loaded the wages that now are considered 174. So we have somebody directly supporting or directly working on a specified research activity. Fully loaded wages now are 174. That's what we need to capitalize. So if you were thinking I could just capitalize what we used in the R&D tax credit, no, we have to put all this additional in. In addition, under supply costs, they say supply costs are 174 expenses, and the cost of supplies, tools, equipment that are not depreciable under 178, which are used or consumed in the performance of a qualified activity or in the support of a qualified activity. Depreciation on equipment that we're using in the R&D process, including property that was placed in service in the tax year begins on or before 2021. So even if it was placed in service before the beginning of 22, we're going to take a part of that depreciation on that equipment that we're using to test or do R&D, prototype activities. That is now a 174. Patent cost, which has always been a 174, they're saying, you're just clarifying, the cost to obtain a patent, attorney fees, making or perfecting a patent application. Travel cost, when we're talking travel cost for 41, that's not a credit for, or a credit expense. For 174 it is. And travel cost to go perform SRE activities or in direct support of SRE activities, that's one section. 4, and there's 11 sections. I think it was 11 sections in this. I'm only going to highlight a few of these sections today. But section 4 tells us this. And then section 4 goes down to say, okay, so we just told you what 174 expenses are. Let's see what we can exclude under 174 as well. So general administrative service departments are functions that only indirectly support or benefit SRE activities. This is good because we were concerned that all these indirect costs would have to come in as well. But what they said, at least in this proposed guidance, is that none of these costs are going to be considered 174 from a capitalization standpoint. Interest on equipment used, let's say, in SRE activities or buildings that are used in SRE activities, not 174. Cost to input data onto a website, cost for hosting a website, not even, because they define software and they're saying basically all the cost of software. These are specifically excluded. Excluded the cost of your internet domain and amounts representing amortization of these capitalized costs, again, are not 174. So they excluded some things here. Further in section 4, we need to allocate. We just talked about the fact, all right, we got depreciation on equipment and there's something that's used in R&D activities. I'll just say R&D rather than SRE. In R&D activities, how do we allocate? What's the system we use? What do we base that on? The bottom line is, they specifically said in this notice, we're going to give you flexibility to figure out what's the best methodology you can use to allocate these expenses to a 174, to an R&D 174 projects. Allocate them, flexibility within it, because for one project or one type of expense, it may make sense to do it based on hours. For another type of expense, it may make sense to do it on square footage. For another type of expense, it may be based on something totally, number of employees. There might be something that just makes sense. They're saying in this notice, we're going to give you that flexibility to do this different within each type of expense. But once you pick that methodology, you need to be consistent. So flexibility and consistency. Flexible on how we do it. Once we do it, consistency every year on how we're allocating these expenses. So that gives us at least guidance. It's telling us we can come up with that methodology. We've obviously need to follow something that makes sense. That's section 4, defining 174. Section 5 goes deeper into software. Because we haven't had a ton of guidance on software. And just so you know, poll question number 3 is about to be launched. So make sure you get poll question number 3. I'm going to be very sad if you don't get your CPE certificates. So poll 3 is now up. Answer that. So computer software. What did they define computer software? Generally, it means any computer program or routine that is a sequence of code. This is actually what they said. I copied and pasted from what they said. Designed to, it's kind of funny, designed to cause a computer to perform a desired function or set of functions. So we all know what software is. They went further to say it's all software that was developed by the taxpayer or use of the taxpayer in his trade or business or for sale or license to others. Kind of thought that, but they clarified that. A new definition that they put in here. So this is interesting and this is helpful. They define something new of upgrades and enhancements. And what they're trying to do is just eliminate simple fixes and maintenance to software. And so what they're saying, in order to be considered 174, the upgrade or enhancement generally means modification to existing computer software that results in additional functionality, enabling it to do something that previously couldn't do, or a material increase in speed and efficiency. So simple fixes, simple maintenance is not 174 according to this guidance we received. But this new definition of upgrades and enhancements to software are considered 174 and need to be capitalized. They went further to say, okay, what are the activities that are treated then as software development for 174? The planning and development of the software, the design of the software, the modeling of the software, the writing, the actual programming and converting it to machine readable code, and the testing. They're saying those are the steps we're considering as part of the 174 capitalized. Software activities related to purchased software, and this was a question because they were prior they were saying all software is considered a 174 expense. That's pretty much how it was reading before this. So here say, okay, if you're purchasing software and this is configured pre-coded parameters, make the software compatible with business, re-engineering the business, or compatible with the purchase software, blah, 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 are not activities that constitute software. So the most part is we get software, we plug it in, make it work. That's not considered a 174 activity. And then further, they're saying for internal use software, the training, the maintenance, the data conversion, the installation, or even purchase software, that is not considered part of a 174 expense. And then further, for software that we develop for sale or license, so we're not using this internally, but we're sales or license, we have activities on that are marketing, maintenance, distribution, customer support. Again, without this new guidance, you may have considered those 174. They specifically say this is not a capitalized expenditure under software for these new rules that unfortunately kicked in last year. So what if we're having R&D done for us? Whose SREs, whose capitalized costs are those? Well, if the provider, and there's a section in there that'll go through, and actually I think I'll put together almost a grid with some checks to see if it's yours or if it's not yours. But if the provider who I contract to bears some financial risk, or they have the right to reuse anything that they learned in that project, even if it's my R&D tax credit, let's say, opportunity, the fact that they bear some of the financial risk, not even all of it, and have the right to reuse something means the provider has a 174 expense. It also goes in to say, well, I'm the recipient. I commissioned you to do this. And if I'm bearing financial risk, I also have a 174. So there's a time that almost looks like where we both have a 174 cost. Not sure they meant that or not, but that's the way it's reading. And then the bottom line is, what has that done for us? It's made, I mean, if I can go through this example if you want, but the bottom line is we've had to capitalize. It's a temporary hit after 5 years, almost back to whole. But the thing I want to point out here, and there's more sections. There's sections, I know we had the question on what if we sell our business? That's addressed in there. That we'll go into in a deeper one. This was more an overview of what 174, because end of the year here, we need to start realizing or figuring out what a 174 expense at the end of a year. We're doing tax planning. You are right now. And so what is a 174 expense? How do I determine what my client's new tax liability is going to be? That gives you a good overview on that. And again, Phil mentioned it. Now that we have the guidance, we are going to be offering that service that we can go analyze a client's 174 expense and come up with that. All right, I'm going to move on to the last section. We have, well, technically at 2 minutes, you're going to qualify for CPE, but I'm going to go through the last section. I'll probably take about 10 minutes on this as well. So we'll stop right about the top of the hour. But the other big news that came out recently, again, those were overviews, R&D overview, 174 overview. Now we're going to do an ERC overview. And the big news that came out recently is the moratorium that came out on ERC. The one thing I want to tell you is qualification hasn't changed. No matter what these people are telling your clients, qualification hasn't changed. The way you qualify hasn't changed. It's been straightforward from the beginning. It's straightforward now. If your client's being told they qualify on something that just doesn't make sense, you need to question it. Bottom line, the drop in revenue or the full or partial suspension are the ways to qualify. The guidance that IRS came out with in the last few months, that they told us they weren't going to give us any more guidance, but there's so much, what's the right word? Misinformation out there. They had to bring this out. You all saw this. This isn't brand new, but it's only a few months old. Supply chain. from day one, we knew supply chain wasn't going to qualify anybody. We've done, I don't even know, I would guess tens of thousands of 941Xs, and 0 of those have been based on supply chain. And you're hearing the buzzword that everybody qualifies on supply chain, and it just doesn't happen. And so, most supply chains, and the IRS came out in this memorandum and said this: supply chains weren't due to a government mandate. Supply chains were due to a lack of employees or bottlenecks because there was more purchasing going on. A client being affected with price increases, that may be a supply chain issue for them. That's not a supply chain issue for ERC. And so all these things came out regarding supply chain that don't qualify you. Bottlenecks at ports, no, not going to qualify you. Residual distributions to the government order. So if there was a supply chain, if you could actually prove that your supplier was shut down in May of 2020, and then they opened for 2 weeks, and then they opened after that, and there was no impact in that to you till 2 months later, that doesn't matter. That impact's gone. You don't qualify. And so I know people will be promised that shortages. They came out and basically used an example. You're a retail store, and there was you could prove that one of your suppliers was shut down, and you couldn't get your clothes sales, and you couldn't get this pair of socks because of a supply chain issue that was due to a government mandate. Well, the fact that you could stay open and you could still sell everything else, doesn't matter that sock was out of stock. That doesn't qualify you. These are the types of things that they just came out in this. Read it. The bottom line, you're going to look at it and say, yeah, supply chain's never going to qualify for my clients. That's what it is. And I'm guessing there is going to be that oddball that'll qualify on supply chain. We've never seen it. And we've done a lot of ERC. We've turned away way more ERC than we've taken. And unfortunately, they've probably gone to somebody else and got that credit. All right, now I'm ranting. I'll go back to the program. What happened next then? July, that came out. Then September, what'd they do? They announced that they're going to stop processing any new ERC claims. So what does this mean? Because there was confusion on this. They did it because what happened is that all of these new claims were coming in, like a huge percentage of new claims were coming in over a 90-day period, because everybody was telling, there was companies out there telling everybody they qualify. And so this was all coming in. And so what IRS had to do is just stop. We're gonna wait. And what we're gonna do during this wait is they didn't say this originally, we're gonna allow you to withdraw your claim. We'll talk about that in a second. What they said during this moratorium is that they were going to, through at least 12/31 of 23, they're going to stop processing any new claims while they can get under this backlog of new claims, which they feel 90% of them are not legit. And I made up that number, but I think I heard that somewhere. What they didn't say, and this is at least from our experience, what we've seen, is that refund checks have also stopped. In fact, the last check we saw sent out to any of our clients was August 28th. Now, they didn't say they stopped. And just so you know, poll question number 4 is up now too. They didn't say they were stopping sending checks, and maybe it's just an oddball coincidence that we have not seen any checks, sent out since August 28th. But it appears from our experience that also is in play right now. When does that start up again? I guess we'll wait and see. There was some comments from the IRS commissioner last week that could have been construed as promising, like that we're going to restart. Well, does restart the ERC mean we have a whole new methodology to do it, or does restart mean we're about to start processing again? So not sure exactly what it meant, but that not news, but at least somebody had commissioner had said the other day is like, okay, we're going to have a restart to this program. And so, but the reason that the commissioner did say that they put this in is, well, you need to they were looking to add new protections and safeguards to stop bad claims from ever coming in. So they wanted to figure out a way that they could do that. So from that, it sounds like when they restart the processing, now I want you to be aware, we didn't stop sending in. Just because they're not processing, we don't want to fall to the back of the line. We're still sending in. So we're still submitting new claims, obviously legit claims. We're not going to, I don't think I even have to say that, but we're not going to send in something that we can't defend. But they didn't say don't stop sending it in. And I know there was some misinformation out there that people heard we're supposed to stop sending in claims. That's not the case. We have not been told that. And so we're continuing to send them in. But based on what the commissioner said, does this mean that there's going to be a new requirement when we submit new additional ones? Does this mean they're going to reject anything in-house now and send it back to us and say, okay, send in these requirements? That's fine. I mean, we're all good with that. We'll show why it qualifies, but we don't know for sure what's going to happen there. After this moratorium came in place, then the newest thing that came out is IRS announced a withdrawal program. Now, this withdrawal program, in my mind, doesn't go far enough, but what this withdrawal program says is that you can ask for IRS to, either ignore your claim or you can refund your claim if you haven't received process, they haven't received it yet, or you received it and you got checks and you didn't cash them. You can go back and you can say, hey, sorry, we looked at this further and we decided that we do not qualify and therefore we want to give this money back. So if what they say is if you used a payroll provider to do the claim, go back to them and have them make changes. If you heard that your credit is under audit, you can make, and you hadn't got checks yet and cashed them, you can actually fax or email a withdrawal request to them. And so they're saying the best way to do this, if you haven't got the checks, so you haven't been told this process, fax in on your 941X or something. I'd have to verify that yes, we are withdrawing our claim. We don't want this. I know you all have clients who have claimed ERC that you've looked at and you realize they shouldn't have done it, and not through you, but through a provider. If at least they haven't cashed a check yet or haven't received a check yet, or in an audit and didn't receive checks yet, they have the ability, no questions asked, to withdraw that claim. And I think that's one reason this moratorium's there is like, okay, let's let taxpayers self-weed out these claims that are out there. The problem with this is there's no partial withdrawals allowed. It's all or nothing. But what it does is it allows you to at least avoid future repayment, penalties, and interest. The thing that this didn't do, which I wish it would do, is I wish that it would have gone a step further. And even if you have cashed it today and you've realized after the fact that you shouldn't have got an ERC, I think they should put a method in place, and this is just my opinion, to allow taxpayers to return that money, no questions asked. Now, will they get charged an interest? Probably. Can they avoid penalties? I think they should do it. I think they should allow taxpayers who, unbeknownst to themselves, their knowledge, they relied on someone else, they claim the ERC, you as the tax advisor look at it, realize they shouldn't have got it. Hopefully there's a point in time where you can do it. Now, we've done this for clients and we've asked for forgiveness, not credits that we've done, but credits that people have asked us to help them with. I think they should give us that opportunity to withdraw those. All right, with that being said, that's the current update. That's where we are on a few things. Again, that was an overview. The plan is to go deeper on 174, hopefully in the next, if it's not December, it'll be early January, but we're hoping in December to go deeper on 174. We really want to see what IRS comes up with the, they're asking for our guidance on the 174 by the end of November. We want to see what that comes out before we dig deep into, everything else. But based on what we've seen so far, that's what we see on 174. If you have deeper questions, don't be afraid to reach out. There's our information, website, info@Tri-Merit, our 800 number. And I think that QR code gets you the same spot. All right. That being said, I know that was a lot in an hour. I know it's an overview. I want to thank everybody for being here. I appreciate your attendance, and don't be afraid to reach out with any questions you have. Thank you and goodbye.